Most people don't lose their wealth during the divorce trial. They lose it years earlier by making one invisible mistake. If you've commingled assets or made emotional concessions during mediation, you're already bleeding capital. We are dissecting the clinical reality of ring-fencing your business and retirement before it's too late. The 2026 Economic Gauntlet. The United States economic landscape in 2026 has transformed the standard divorce settlement from a simple math problem into a high-stakes geopolitical puzzle. We are currently navigating an era defined by sticky inflation and interest rates that remain stubbornly higher than the market's optimistic forecasts. In this environment, the traditional 50-50 split of a marital home or a retirement portfolio is no longer a neutral event. High asset prices, while looking good on a balance sheet, now carry significant tail risk. If the economy shifts, the liquidity of those assets can evaporate overnight. Furthermore, the shift toward the privatization of divorce resolution means that the burden of fairness has moved away from the courts and onto the shoulders of spouses and their specialized legal teams. In 2026, a high net worth split isn't just about who gets the house. It's about who is left holding the most tax-efficient, inflation-protected assets in a market that is increasingly volatile and unforgiving. Identifying the red alert assets. As soon as a divorce filing is imminent, a phenomenon known as asset concealment often begins, where high-value items or funds seemingly vanish into thin air. In the modern digital era, this has become more sophisticated than just skimming cash from a joint account. Common tactics in 2026 include transferring property to trusted family members, underreporting business income, or even creating fake debts to artificially deflate the appearance of marital wealth. We are also seeing a red alert on digital assets and offshore accounts, where strict privacy laws are leveraged to hide wealth from the reach of the court. Furthermore, physical assets like real estate are facing new risks. High interest rates have increased the cost of ownership so significantly that what was once a crown jewel asset can quickly become a negative equity trap if the property is underinsured or located in a high-risk climate zone. Harvard University 2026, NHESS 2026. If you aren't tracking these shifts the moment the papers are served, you aren't just losing money, you're losing your future leverage. The high cost of emotional decisions. The most dangerous variable in a 2026 high-asset split isn't the tax code, it's the human brain. Economic pressure and the resource scarcity mindset of a divorce trigger intense psychological strain, which leads to self-protection strategies that actually backfire. When emotional volatility, such as anxiety, irritability, and depression takes over, it impairs an individual's ability to assess social exchange value accurately. In high net worth cases, this often manifests as a desperate need to win a specific asset, like the family home, regardless of the crushing mortgage rates or maintenance costs that will follow. These emotional premiums are the silent killers of wealth. By making decisions based on sentiment rather than psychological capital, the internal resilience and optimism needed to navigate uncertainty, spouses often trade away long-term financial security for short-term emotional satisfaction. Frontiers in Psychology, 2026. In the 2026 economy, the person who keeps their cool and treats the divorce as a business merger is the only one who truly walks away with their net worth intact. Distinguishing between mine and ours. The Geller-Green precedent, defining the boundaries. In the landscape of modern American family law, the distinction between separate and marital property is the fundamental battlefield of every high-asset divorce. To understand this, one must look at the historical Geller-Green framework, a conceptual benchmark in legal education that distinguishes between assets brought into a union and those cultivated during it. In 2026, United States courts have moved toward a more rigid interpretation of these boundaries. Separate property generally includes anything owned before the marriage or acquired during the marriage by specific gift or inheritance, provided it was never integrated into the marital estate. However, the complexity arises because the presumption of marital property is stronger than ever. Under current U.S. statutes, if an asset exists at the time of filing, the court assumes it is marital unless the individual can provide clear and convincing evidence to the contrary. This shift means that the burden of proof has moved from the challenger to the owner, making the legal definition of mine much harder to defend than the communal definition of ours. The commingling trap and the art of tracing. The most frequent financial tragedy in 2026 divorces is the commingling of premarital investments and inheritances. It often begins with a simple, well-intentioned gesture, depositing a legacy check from a grandparent into a joint high-yield savings account, or using a pre-marriage brokerage windfall to pay down the mortgage on a shared family home. In the eyes of the law, this often triggers transmutation, where separate property loses its individual identity and becomes a gift to the marriage. To combat this, forensic experts utilize a process known as direct tracing. This involves a granular, dollar-for-dollar reconstruction of account history to prove that the separate character of the funds was never truly abandoned. In 2026, courts are increasingly looking at intent alongside the math. If you used separate funds to improve a joint asset, you must prove you didn't intend it as a marital contribution. Without a paper trail that survives the passage of time, the law tends to favor the partnership, effectively socializing your private wealth into the marital pot. Digital footprints and 2026 forensic accounting. As we navigate 2026, the paper trail has been replaced by a digital footprint, and forensic accounting has evolved into a high-tech discipline involving AI-driven data mining and blockchain analysis. Proving asset ownership now requires more than just old bank statements. It involves a deep dive into the metadata of financial transactions. Modern forensic accountants use specialized software to identify ghost transfers and hidden digital wallets that may have been used to siphon off marital funds or obscure the origins of separate property. Every click to buy, every automated transfer, and every login timestamp serves as a witness in the courtroom. Furthermore, the 2026 legal standard places immense weight on financial transparency. If a spouse is found to have manipulated digital records or failed to disclose a fractionalized asset, like a microinvestment in a private equity platform, the court may apply draconian penalties, including awarding the entire value of the hidden asset to the other party. In this environment, your digital history is either your greatest defense or your most damning evidence. The ability to prove that an asset remained separate depends entirely on the integrity of the data you left behind. The strategy of financial sovereignty. Ultimately, surviving a 2026 financial reality check requires a shift from emotional trust to administrative discipline. The hook for anyone entering a high-asset split is realizing that the law does not reward fairness in the way most people define it. It rewards documentation. Securing a financial future means maintaining financial sovereignty even within a partnership. This involves keeping inheritance in segregated accounts, avoiding the use of marital income to pay for separate property taxes, and ensuring that any premarital business interests are shielded by updated valuations. In the current U.S. legal climate, the difference between walking away with your legacy and seeing it split down the middle often comes down to a single digital timestamp or a properly categorized deposit. By treating the distinction between mine and ours as a continuous administrative task rather than a post-filing emergency, you ensure that your financial identity remains distinct, protected, and provable. Tactical defensive maneuvers. The preemptive pivot, establishing financial autonomy. In the high-stakes environment of 2026, the most critical defensive maneuver is establishing financial autonomy long before a formal break is ever discussed. This isn't about secrecy. It's about maintaining a financial life raft. The first step is the strategic establishment of individual credit lines and separate banking institutions. In a modern U.S. divorce, joint accounts are often frozen or depleted within hours of a filing, leaving one party incapacitated. By securing a high-limit credit card in your name only and ensuring it is serviced by a bank where no joint assets are held, you preserve your liquidity of defense. This ensures that you can retain top-tier legal and forensic counsel without needing a court order to release marital funds. Furthermore, opening a separate checking account to receive post-separation income is vital. Under 2026 legal standards, once the date of separation is established, income earned is typically separate property. If that income hits a joint account, even for a day, you risk the merger of funds argument, potentially handing half of your post-break hard work to your spouse. Modern trust structures and ethical shielding. Leveraging modern legal instruments like domestic asset protection trusts has become a standard procedure for high-net-worth individuals in the United States. Unlike the offshore accounts of the past, 2026 asset protection is focused on transparency and statutory compliance within states like Nevada, South Dakota, and Delaware. These structures allow an individual to be a discretionary beneficiary of their own trust, shielding assets from future creditors, including a divorcing spouse, provided the trust was established and funded well before marital discord was reasonably foreseeable. The ethical and legal line is drawn at fraudulent conveyance. You cannot move assets into a trust to specifically hinder a known pending divorce. However, using these structures as part of a long-term estate plan is a powerful defensive move. These trusts often include spendthrift clauses that prevent a court from forcing a distribution to satisfy a divorce judgment, effectively placing the principle of your family legacy out of reach, while still allowing for ethical, court-ordered support payments from the income generated. The intellectual property battleground. In 2026, the side hustle is no longer a hobby. It is often a significant source of intellectual property and recurring revenue that becomes a major battleground in settlements. Whether it is a software patent, a monetized content channel, or a proprietary AI model developed during the marriage, the court views these as marital assets if marital effort or marital funds contributed to their growth. To protect these, tactical defense requires a valuation wall. This involves drafting interspousal agreements or postnuptial amendments that specifically categorize IP as separate property. If you are generating revenue from a side project, it is essential to operate it through a formal entity, such as an LLC or S Corp, with a clear operating agreement that defines ownership. Forensic accountants in 2026 are trained to look for active appreciation, the increase in value of a separate asset due to the owner's efforts during the marriage. By documenting that your marital effort was already fully compensated by a fair salary paid by the business, you can argue that the growth in the company's valuation remains a separate, non-divisible achievement. Securing the 2026 digital revenue stream. The final frontier of defensive maneuvering lies in the protection of digital revenue streams, from subscription models to fractionalized digital royalties. These assets are notoriously difficult to value because their future earnings are often speculative. In 2026, the tactical move is to secure a buy-sell agreement or a fixed value clause within your business structure. This allows you to buy out a spouse's potential marital interest at a predetermined fair market rate before the business experiences a massive valuation spike. Without these protections, you risk a percentage of revenue award, where a former spouse could potentially collect a portion of your creative or professional output for years to come. In the modern U.S. economy, your ability to innovate is your greatest asset. Ensuring that your future ideas aren't pre-owned by a past relationship is the ultimate act of financial self-preservation. The digital and crypto paper trail. The myth of anonymity. 2026 transparency standards. The era of the untraceable offshore account, or the invisible digital wallet, has effectively ended in 2026. Under the current United States legal framework, including the fully realized enforcement of the Corporate Transparency Act and new FinCEN residential real estate reporting rules, the veil of anonymity has been lifted. If an individual attempts to hide marital wealth in a decentralized wallet, they are playing a dangerous game with federal and state statutes. Modern family courts now treat cryptocurrency not as a legal gray area, but as standard marital property, subject to the same disclosure mandates as a savings account. Failure to disclose these assets is no longer just a civil dispute. It can lead to charges of fraud, contempt of court, and draconian sanctions, where a judge may award 100% of the hidden asset to the honest spouse. In 2026, the transparency is absolute. Between tax filings that require the disclosure of digital transactions and the ability of forensic teams to link bank withdrawals to crypto exchange on-ramps, the trail is always there. Tracking the non-fungible and private equity. While many focus on Bitcoin or Ethereum, a significant portion of modern wealth is tied up in non-fungible assets and private equity stakes that are frequently overlooked. In 2026, high net worth splits often involve complex valuations of non-fungible tokens, NFTs, tokenized real estate, and fractionalized interests in private equity platforms. These assets are non-fungible because they are unique and often lack a standard market price, making them ripe for undervaluation during a divorce. However, forensic accountants now utilize advanced blockchain analytics to unmask these holdings. By tracing a spouse's digital signature across various decentralized finance, DeFi protocols, experts can identify staked tokens, liquidity pool shares, and yield-bearing accounts that don't appear on traditional brokerage statements. If Ross is sitting on a private equity stake in a tech startup or a high-value digital collectible, he must realize that out of sight is no longer out of reach. The court's reach now extends into the metadata, ensuring that every fractionalized unit of wealth is accounted for and divided. The digital lifestyle audit. Social media as primary evidence for alimony and child support audits. In the modern courtroom, a poverty plea regarding financial hardship is immediately cross-referenced against your Instagram stories, TikTok videos, and LinkedIn activity. If a spouse claims an inability to pay support while simultaneously posting about luxury vacations, high-end purchases, or a new business venture on social media, those posts are admitted as evidence of a lifestyle inconsistent with reported income. Furthermore, LinkedIn has become a primary tool for imputed income arguments. If your professional profile showcases high-level skills and a vast network, the court may impute a higher salary to you, regardless of whether you are currently employed. Every check-in at a high-end restaurant and every photo of a new luxury vehicle serves as a digital receipt. In 2026, your social media presence is essentially a public financial disclosure, and it is being used by forensic teams to build a narrative of your true standard of living. The strategy of total disclosure. The ultimate reality check for a digital-age divorce is that the person who hides nothing is the one who risks the least. In the current U.S. legal environment, the gotcha moment, where a forensic accountant reveals a hidden ledger or an undisclosed private equity stake, is the single most common cause of settlement collapse and reputation ruin. The strategic move is to undergo a digital self-audit before the filing process begins. This means gathering all private keys, exchange records, and entity-related documents to ensure your financial affidavit is bulletproof. By being the one to provide the complete picture first, you retain credibility with the court and prevent the opposition from using incomplete data to paint a picture of deception. In 2026, financial integrity is your most valuable currency. Protecting your future wealth starts with acknowledging that in the eyes of the law, every digital footprint is a permanent record. Building the post-divorce empire, the wealth mindset, from division to optimization. In the 2026 economic landscape, the true winners of a high-asset split are those who stop viewing the settlement as a loss of 50% and start viewing it as the optimization of the remaining 50%. When a marital estate is divided, you are often left with a portfolio that was designed for a two-person household with shared goals. These legacy investments may no longer serve a solo empire-building strategy. The first step is a radical audit of tax efficiency. In 2026, the focus has shifted from mere capital gains to tax loss harvesting and the strategic use of opportunity zones or 1031 exchanges to defer taxes on liquidated marital assets. By repositioning your settlement into assets with high psychological capital, investments that align with your personal risk tolerance and future cash flow needs, you transform a static settlement into a dynamic engine for growth. The goal is to exit the marriage with a lean, aggressive portfolio that is unencumbered by the compromise of a partner's conflicting financial fears. Navigating the real estate exit in a high-interest market. Liquidating joint real estate in 2026 is a tactical challenge, as high interest rates have created a lock-in effect where buyers are scarce and market volatility is high. To avoid getting crushed, the strategy must move beyond a simple for sale sign. Many sophisticated couples are now utilizing assume-the-rate negotiations or seller financing models to make their property more attractive to buyers who cannot qualify for traditional bank loans at current rates. If the marital home has a legacy mortgage with a low interest rate from the early 2020s, that mortgage itself is a high-value asset. Strategic settlements in 2026 often involve one spouse buying out the other's equity through a structured payment plan rather than a forced sale, allowing the property to appreciate until the market stabilizes. Furthermore, for those who must sell, utilizing concierge listing services, where renovations are funded by the brokerage and paid back at closing, can ensure the property hits the luxury tier pricing needed to offset high transaction costs and inflation-adjusted commissions. The Ross and Rachel Guide to the 2026 Legal Team. Choosing your legal representation is the single most important business decision of the entire divorce process. In 2026, the pitbull litigator model is increasingly seen as a liability that leads to wealth destruction through endless billable hours and scorched earth tactics. The modern Ross and Rachel strategy prioritizes a mediation-first legal team. You need a firm that treats your divorce like a corporate merger and acquisition (M&A) deal, rather than a street fight. Look for a team that includes or works closely with a certified divorce financial analyst (CDFA) and a forensic specialist who understands the 2026 digital paper trail. Your attorneys should be settlement-minded, prioritizing collaborative divorce protocols that keep the details of your assets out of public court records. In an era where digital privacy is a premium and market speed is essential, the best legal team is the one that gets you to the signing day, with your reputation intact and your legal fees representing a fraction, not a percentage, of your net worth. The Empire's Foundation. Strategic reinvestment. The final move in building your post-divorce empire is the immediate reinvestment of liquidated funds into the 2026 growth sectors. This involves moving away from the static 60-40 portfolio and toward alternative investments such as private credit, green energy infrastructure, or AI-driven biotech, which have shown resilience in the current inflationary cycle. By working with a wealth manager to create a new beginnings investment policy statement, you ensure that your assets are working as hard as you are. Remember, a high-asset divorce isn't the end of your financial story. It is the Series B funding for your next chapter. The Ross and Rachel reality of 2026 is that while the relationship may have reached its series finale, your personal financial empire is just entering its most profitable season.